You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mikey Hu. Hey, what's up, Market Moose? Mike from The Moose and the Loose. I hope you are doing well this Monday. Over the past weeks, I was off, as you know, but I was still in discussion with a lot of my members and got an email that was like very, very interesting about concerns about the timing of investing right now. And what I found interesting from that member's email is he's highlighting a lot of very good point of not investing right now and raising some very valid concern. So we're going to talk about that. But just to give you in perspective, this member is about to retire. So of course, the level of anxiety around the market crash, around making bad investment decisions or bad financial decision altogether, I mean, it's rising, of course, because when you're younger, you're always telling yourself that you have plenty of time, that you can recover. But when you're about to retire, or if you're in your first years of retirement, your financial decisions, not just about investing, but about like when you take CPP, when you take OAS, like just the simple decision of retiring. Like, do you have enough money? Are you like old enough, young enough? All that those decisions are very, very important, have a huge impact, and some of them are almost irreversible, such as investing right now and fearing that the market's going to crash. And I've discussed this at the beginning of the month from a retirement perspective, like what happens if we have a market crash and fall. And there are a lot of like good points telling us that it could happen. Of course, I mean, we have like the tariffs. We don't know where it's going to end up, but we have like a lot of wars that are exploding here and there. So there's a lot more political tensions. We're not necessarily completely getting rid of inflation, even though it's now in control in Canada. Price has not gone down. So now, like, what was the price of whatever goods you were paying like 4 years ago, it's never going to get back to that level today. And that poses another problem, right? So with all of those signs and governments printing tons of money, not necessarily, and sometimes I wish they were more responsible, because you cannot just print money and borrow debt forever. You'll have to pay it down at one point. So anyways, with all of those things in mind, and the member even said, like, I'm not a like doom and gloomer. I'm not like listening to podcasts telling me it's the end of capitalism, it's the end of the world, but I'm just thinking maybe what we are seeing right now is not sustainable. And actually, to be honest, we've been running in a crazy bull market for so many years that we are probably long time due for a good market crisis. Like, not a correction. Like, people, like, they freaked out on Liberation Day because the market went down 10%. I mean, that's just like regular stuff. That's just another Tuesday in my mind. We had like a small bear market in 2022, another one in 2020, and then another one in 2018. But those like were super fast recoveries. So the fear of seeing something a lot bigger and long lasting, maybe a crisis that would like hurt the market for like 4 or 5 years, that is definitely something that could happen. So what can we do about that? How can we position our portfolio just before retiring, and still sleep well at night, right? And on the other side, I mean, you probably cannot afford to put everything in GICs or a high rate savings account and hoping that it's going to be enough, right? So you probably need a little bit more returns. So there you go. You have that problem of a portion of your portfolio will have to be invested in stocks. So let me remind you a story now before we go to the solution at the end of this show. So imagine a world where unemployment rate is at 8.5%, that the governments are printing money like there's no tomorrow. They're actually like leveraging big time. They're borrowing a lot of money. Debt is on fire everywhere. Like, a lot of like countries are getting to more and more debt to finance this, to try to help people finding jobs and so on. most analysts, most investors are saying the Fed, central banks, they have no clue what they're doing. Absolutely no clue. They're like just a bunch of amateur like throwing up numbers, and it's going to all fall. And when you listen to earnings calls from businesses, and not just about politics and government, but I mean, companies are slashing their guidance, they're suspending them, they're reporting losses. It's not going well. There's like a big loss of faith in the banking system. So we fear of a bank run. We think like banks are not strong enough anymore and it's all going to collapse. And then you thought, oh, my house is a good place to invest. Well, think again, because housing price dropped by like 20-30% on that year. So your house that you bought $500,000 last year, now it's worth $350,000. So pretty good deal, right? So even there's no place to hide. And then what we keep reading everywhere is this time is different. Like this time is like it's not going to be like the other crisis. It's going to like kill capitalism, or it's going to be like ugly for like maybe a decade, maybe more, just to recover. And then a few months happens and it's getting a little bit better. But now as it gets better and we think that the world will finally recover and the stock market is like doing not so bad, well, then we have like European countries in deep problem. So Greece debt to GDP ratio over 170%, Italy over 125%, Portugal over 120%, Ireland over 110%, Spain 90%. And those debt to GDP ratio, they are rising fast. And now those countries issue bonds in high single digit, sometimes double digit, like over 10% interest rate on Greece bonds at one point. Kind of crazy, right? And now we're not finding any solution because we have filled like government with austerity measures like spending cuts and tax hikes to control debt, which makes the whole situation even worse because it puts a major brakes on the economy. And as you can imagine, what I just described was everything that happened between 2009 and 2013. So between January 2009 and 2013, the S&P 500 was up 58%. And it is obviously, as we know now, the beginning of one of the strongest bull market ever. If you were a genius and you skipped the crisis of 2008, say, hey, I knew it was coming. So you sold in 2007, or early 2008. Well, during that time, well, all right, you're a genius, but when is it the right time to get back in? So not 29, not 2010, not 2011, 12, 13, and then the stock market is up. Actually, if you sold everything on January 2007 to go back in January 2013, well, you just skip volatility, but you just bought actually exactly the same price. And that would be, again, fluke, because no one in the world, you would know that 2013 was actually a good time. So again, impossible. And those are all pretty good reasons right now to not to invest, right? But that was like the beginning of like one of the best bull market ever. So I'm not telling you that what's going to happen is that we're going to ride another bull market for 10 years. I don't know. I don't know. You don't know. Nobody knows, right? Some people will say, well, what about 1929, right? Well, I mean, we could also talk about Vikings and the Roman Empire. I mean, the crisis of 1929 happened 100 years ago. So nothing is the same anymore today. I'm not saying it cannot happen again, but you could also imagine that Vikings are going to invade Canada at one point if you want to go like the apocalyptic route, right? So at this point, you have to do something. And that something is actually three things. You can stay on the sideline forever and keep wondering maybe one day it's going to be the right day to invest in the market. You can stay invested like me. Like I found it so much easier. Since 2003, always been 100% invested. But I get that if you have like built a business, built like some real estate, you're selling it right now because you want to retire and it's your first time you have a big lump sum of money, it's scary. So what I would suggest you to do is to actually determine a time frame to invest that money. So specific time frame with specific amount. Like for example, 1/3 every 3 months. So you invest everything over the course of 9 months. Why 9 months? Well, if you look at past history, most of the crashes happen over a 6 to maximum 9-month period. Because after a while, investors are just getting tired. They don't see the light anymore, but they just stop trading. There's less volatility, less volume. So the stock market just like stay low for a while until more information, more data comes back, and then it recovers. So if you invest 1/3 every 3 months, the good news is if the market crash has happened today, well, you'll have 2/3 of your money that will be invested as the market goes down. So you're going to be capturing most of the drop. But the other thing that could happen is the market stays the same. So you would just then slowly getting invested, and best case scenario, the market would go up, and then you would gradually get into the boat trying to get some profit and be a little bit in a better place when the market crisis happen. And in the end, when you think about that, when you look at like the major crisis of 2008 and the tech bubble of 2000, it took about 4 to 5 years to fully recover. So if you have a solid plan, you have a cash reserve, you can invest everything, and then worst comes to worst, you're going to go through a lot of volatility. It's not going to be fun, but 4 years down the road, if you retire, chances are you're going to be retired for like 20, 25 years. So what's 4 years out of 25? Like, it's a period of time, but it's just a season. And I mean, we're almost done with summer already, so you know how fast season passed by, right? So that's my trip. My trick would be just to have fixed amount, fixed number of time, and then you follow that plan instead of like following the news. Because following the news, you're just going to get lost into the noise forever. So, all right, Moose, that's enough for today. We're going to get back on Wednesday, still keeping the summer the summer routine for now. Slowly getting back on track. Actually, it's my first day that I'm really working, so I have to put some emphasis on DSR and retirement loop. And once that everything's under control, then I'm gonna get back to the full moves on the loose every day of the work week. So, all right, Moose, take good care, and until Wednesday, don't forget to stay invested. Hey, welcome to the disclaimer. If you're listening to the Moose on the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.